Hello dear students, welcome to the sixth session on the chapter Admission of a Partner. Here in this session, let's have a discussion on the important concept, that is Memorandum Revaluation Account. Let's see the meaning now. Memorandum Revaluation Account is prepared when, at the time of admission of the partner, the partnership firm does not want to change the values of assets and liabilities in the balance sheet but wants to show its effect through partners' capital accounts. Memorandum Revaluation Account is not prepared on the basis of double entry system. Okay, so here the important point is to understand when we are supposed to prepare the Memorandum Revaluation Account. Usually at the time of admission of the partner, we prepare three accounts. The first one is Revaluation Account, second one is Partners Capital Account, and the third one is we prepare balance sheet. Okay, so these are the three accounts which we prepare at the time of admission of the partner in almost all cases. But in some cases, instead of preparing revaluation account in the first step, we prepare memorandum revaluation account. We need to understand in which case. Okay, here it is specifically given that at the time of admission of the partner, when the partnership firm does not want to change the values of assets and liabilities in the balance sheet but wants to show the effect of revaluation through partners capital account, we have to prepare the memorandum revaluation account. Okay, so here, which means that when you see a problem, if you find a sentence that values of assets and liabilities should not be altered, only in such a case we are going to prepare the memorandum revaluation account. Usually when we prepare the revaluation account is prepared on the basis of double entry system. Okay, when we follow the double entry system, we have to record both the sides of transaction when we write a journal entry. But that is not going to happen when we prepare the memorandum revaluation account. Let me give an example. Let's suppose that the value of machinery given in the question is rupees 1 lakh. We have, and in the adjustment it is given that reduce the value of machinery by 10%. So reduction in the value of machinery, when you calculate 10% on 1 lakh, which comes to 10,000. Now if we are preparing the revaluation account, what is the entry we write? Reduction in the value of machinery is a loss. To write that, we write the entry revaluation account data to machinery account. So when we prepare the revaluation account, it is based on the double entry system. So we have to write both the sides of transaction in the respective accounts. In the revaluation account, we write to machinery account 10,000 rupees, and in the machinery account we write by revaluation account 10,000. Okay, so because we are following the double entry system. So now in the machinery account, already the opening balance we have is 1 lakh rupees. Okay, so now after this entry, suppose we are going to close these account in the machinery account. So here 1 lakh rupees opening balance was there. So when you deduct this reduction in the value of machinery at the time of revaluation, finally you will have a balance of 90,000 by balance carried down. So this is the closing value of machinery. When we prepare the balance sheet, the value of machinery will appear at revalued figure, that is 90,000. So this is the procedure which we follow at the time of preparing the revaluation account, then partners capital account, and finally when we prepare the balance sheet. So when we prepare the revaluation account, the value of assets and liabilities will appear at the revalued figure after taking into consideration the revaluation adjustment. Okay, but that is not going to happen when we prepare the memorandum revaluation account, because the memorandum revaluation account is not prepared on the basis of double entry system. So let us take up the same example here, and let's understand what is the change which we have to follow at the time of preparing the memorandum revaluation account. Let's suppose that the value of machinery here is 1 lakh, and we have to reduce the value of machinery by 10%, which comes to 10,000. So now what is the modulated entry we have to write here? Memorandum revaluation account data to machinery account. But though we write this journal entry, we are not going to pass the corresponding entry in the machinery account, because we are not going to follow double entry system. Only one part of the transaction will be recorded in the memorandum revaluation account. So in the memorandum revaluation account, we are going to write to machinery account 10,000. Okay, without passing corresponding entry in the machinery account, the opening balance in the machinery account is 1 lakh. Okay, opening value is 1 lakh. Now if we are not passing corresponding entry for revaluation adjustment in the machinery account, the machinery account will be shown at the same value, that is 1 lakh rupees was the opening, and here now when you calculate it is same 1 lakh. The closing value will also be 1 lakh. By balance carried down will be 1 lakh. So whenever we prepare the memorandum revaluation account, the entry will be passed without passing corresponding entry in the respective assets and liabilities account. We are just showing the effect of revaluation only in the memorandum revaluation account. So this is just one adjustment. Similarly, there might be some other adjustments also. We record all the adjustments of revaluation with regard to assets as well as liabilities and close the revaluation account, memorandum revaluation account, to see whether there is net profit or net loss. Okay, whether there is net profit or net loss, it will be adjusted to the partner's capital account. So that is the main intention of preparing the memorandum revaluation account. So here we don't want to change the values of assets and liabilities, but want to show the effects of revaluation through partner's capital account. So that is why we prepared the memorandum revaluation account. I hope you understood this example. So when we prepare the memorandum revaluation account, we just show the effect of revaluation in the memorandum revaluation account. The corresponding entries will not be passed in the assets and liabilities account. As a result, the assets and liabilities account will be appearing at the old values itself. So when we prepare the memorandum revaluation account, after that we are going to prepare the partner's capital account, and when finally we prepare the balance sheet, the values of assets and liabilities except capital will appear at their old values, old figures. Okay, because in this problem you find the sentence that the values of assets and liabilities should not be altered. Should not be altered means the values of assets and liabilities should be shown at the old values itself. Okay, so this is the meaning of memorandum revaluation account. Okay, then the next concept here is how to prepare the memorandum revaluation account. Okay, so we have already seen how to prepare the revaluation account. We pass three entries here. First entry will be for recording the various losses on revaluation. The entries revaluation account data to various losses on revaluation account, and the second entry for recording the various profits on revaluation. We write the entry various profits on revaluation account data to revaluation account, and then we are going to close the revaluation account to see whether there is net profit or net loss. Okay, so revaluation account has only one section to calculate whether there is net profit or net loss. Whether there is net profit or net loss, it will be transferred to only old partners capital account in the old profit sharing ratio. Okay, that is about revaluation account. Now let us see what is the changes we have to inculcate while preparing the memorandum revaluation account. Okay, this account means memorandum revaluation account has two parts or two sections. In the first part or in the first section, which is similar to the revaluation account. So how we prepare the revaluation account? The same three entries will be passed when we prepare the memorandum revaluation first section. Okay, we show all the losses on the debit side, all the profits on the credit side, and we are going to close the revaluation account. The profit or loss will be transferred to old partners capital account. So the first section of the memorandum revaluation account is similar to the revaluation account. Okay, here it is given that the profit or loss on revaluation of the first section will be either credited or debited to old partners capital account in the old profit sharing ratio. So this is about the first section. After that, you are going to continue the memorandum revaluation account. In the second part or in the second section, the entries made in the first part are reversed because we don't want to change the values of assets and liabilities. Okay, so whatever the entries you have done in the first section, that is going to be reversed. You are going to pass the reverse entry. In the first section, we have shown the various losses on the debit side. Now in the second section, you are going to show those losses on the credit side by passing the reverse entry. The reverse entry will be various losses on revaluation account data to memorandum revaluation account. Okay, similarly, in the first section, we show all the profits on the credit side, but now when we are going to reverse that, we write the entry memorandum revaluation account data to various profits on revaluation account. So just you are passing the reverse entry. Earlier in the first section, loss was shown on the debit side. Now we are going to show on the credit side. Similarly, earlier the profits were shown on the credit side. Now we are going to show that on the debit side. Okay. After that, you are going to balance the second section of the memorandum revaluation account. You will have either profit or loss. In the first section, if you have profit, in the second section you will have loss because you have reversed the entry. On the other hand, if there is a loss on the first section, then you will have profit in the second section because it is just the reverse of what you have written in the first section. Okay, but the major difference here is that whatever the net profit or net loss you get in the first section, that will be transferred only to the old partner's capital account, but the second section, either profit or loss, that will be transferred to all the partners capital account including the new partner in the new profit sharing ratio. So this is the main difference which we come across while preparing the memorandum revaluation account. The profit or loss of second section in the memorandum revaluation account should be transferred to all partners capital account in the new profit sharing ratio, because the decision of not altering the values of assets and liabilities, that is taken by all partners together including the new partners. So whatever the profit or loss that they come across by not altering the values of assets and liabilities, that is by reversing the entries which we have shown in the first section, that should be borne by all the partners including the new partner. That is why we are going to use the new profit sharing ratio to distribute the profit or loss of the second section, because the decision of not altering the values of assets and liabilities are taken by all the partners including the new partner. Okay, so this is the main adjustment or main important concept which we come across in the memorandum revaluation account. Okay, here memorandum revaluation account is just prepared to know the amounts by which adjustment entries have to be passed in the partner's capital account. That's what we discussed in the previous slide, because we don't transfer corresponding entry in the values of assets and liabilities account. As a result, assets and liabilities will be shown at the old values itself. Okay. Then the next concept here is differences between revaluation account and memorandum revaluation account. So this is very important from the theory point of view. You will get one question for 6 marks in the semester for this theory part, that is state the differences between revaluation account and memorandum revaluation account. So now you will be able to understand what are the differences, because we have already discussed in detail what is the meaning of revaluation account, what are the entries we have to pass, and also we have solved some questions on revaluation account. Now in this video, initially we just discussed what is the meaning of memorandum revaluation account and how to prepare that. Now we have to state what are the differences between revaluation account as well as memorandum revaluation account. Okay, the first difference, let's see. Revaluation account is prepared when the assets and liabilities are shown in the balance sheet at the revalued figure, but the memorandum revaluation account is prepared when the assets and liabilities are shown in the new balance sheet, means the balance sheet of the reconstituted firm at the unaltered figure or old figure. So this is the main difference which we have. Revaluation account, when we prepare, the values of assets and liabilities will be shown in the balance sheet at revalued figure, but when we prepare the memorandum revaluation account, the values of assets and liabilities except capital will be shown at their old values, okay, unaltered values. So this is the first difference. And the second difference is that revaluation account is not divided into two parts. Okay, it is prepared to record the increase or decrease in the values of assets and liabilities. The revaluation account has only one section. We pass two entries. The first one to record the various losses, then to record the various profits on revaluation, then we are going to close the revaluation account to see whether there is net profit or net loss. So revaluation account is prepared only in one section. On the other hand, memorandum revaluation account is prepared in two sections. In the first section, which is similar to the revaluation account, but the second section, we prepare the second section to reverse the entries which we have shown in the first section. Okay, so revaluation account is not divided into two sections, but memorandum revaluation account is divided into two sections. So this is the second difference. Then the third difference between memorandum revaluation account and revaluation account is that the balance of revaluation account, that is whether there is profit or loss, that will be transferred to only old partners capital account in the old profit sharing ratio. But on the other hand, since there are two sections in the memorandum revaluation account, the first section is similar to revaluation account. So the effect of revaluation in the first section, that will be transferred to only old partners capital account in the old profit sharing ratio. But coming to the second section, the effect of that, whether there is profit or loss, that will be transferred to all partners capital account in the new profit sharing ratio. So this is the third difference between the memorandum revaluation account and revaluation account. Then let us take up one question where we are going to prepare the memorandum revaluation account. Okay, this is the same question which we have discussed in the first video when we discussed about revaluation account. Okay, there taking the same question we prepared revaluation account. Now for the same question we are going to prepare the memorandum revaluation account. Let's see the question now. A and B are partners sharing profits and losses in the ratio of 3:2. Their balance sheet as on 31st December 2016 was as follows. They have given cash in hand, bills, receivables, debtors, investments, stock, furniture, machinery and buildings. On the liability side we find bank overdraft, creditors, bills payable, investment provision, capital of A and B. In the adjustments they have given, they agreed to take C into partnership, giving him 1/4 the share. The following adjustments are to be made on C's admission. A provision of 5% on debtors is to be created for doubtful debts. B. Rupees 200 is to be written off against bills receivables which represent dishonored bills. Third one, stock is to be valued at 18,000, machinery is to be reduced by 10% and furniture by 5%, buildings are to be appreciated by 20%, the market value of the investment is only 7,500, a provision of 3% is to be created on creditors for discount, a provision of 600 is to be made against outstanding legal charges, accrued income of rupees 1,000 is not recorded in the books. Prepare memorandum revaluation account. Okay. So as I said just now, this is the same question which we have taken up while solving the question on revaluation account. Okay. If at all revaluation account was prepared, what is the adjustment which we have done? These are the adjustment which we have done. It is the same solution which we have discussed in the previous videos. Okay. So this is the adjustments. We have shown the various losses on the debit side and various profits on the credit side, and we closed the revaluation account and we got net profit of 140 which was transferred to A and B's account in 3:2 ratio, that is old profit sharing ratio. But here the requirement is not to prepare the revaluation account but to prepare the memorandum revaluation account. As I discussed just now, memorandum revaluation account is prepared in two sections. The first section is similar to the revaluation account, this one, but in the second section the effect of the revaluation, it should be transferred to all partners capital account in the new profit sharing ratio. So if the requirement is to prepare the revaluation account, directly you can prepare the revaluation account. But if the requirement is to prepare the memorandum revaluation account, before you start with the preparation of memorandum revaluation account, you have to show the working note for the calculation of new profit sharing ratio. Let's analyze which case of calculation of new profit sharing ratio is applicable in this question. They have given two informations here. The old partners were A and B and their old profit sharing ratio was 3:2. And one more information given here is C is admitted into partnership, giving him 1/4 share. So these are the only two informations given. So which case is applicable here? Case 2 is applicable. So whenever case 2 is applicable, we have to make an assumption that the old partners are going to continue in this future in the same ratio as before. Okay. So in such a case, how to calculate the new profit sharing ratio? Let's see that. So in the working note, you have to write calculation of new profit sharing ratio of A, B and C as per case 2. Given that old profit sharing ratio of A and B is 3:2 and the share of new partners C in the future profit is 1/4. So we have to assume in case 2 that the total share of the firm is 1, and then we are going to calculate what is the remaining share of the total firm which has to be distributed between A and B, because C is given 1/4 share. Okay. If the total share of the firm is 1, the remaining share will be calculated like 1 minus 1/4. So remaining share of the firm is 3/4. Now how to calculate the new share of old partners? New share of old partners is equal to remaining share into ratio of sharing the remaining share. In this case, as we assume that the old partners are going to continue in the same ratio as before, so we can assume that the old partners, that is A and B, are sharing the remaining share in the old share as per old share, that is 3:2. So as per case 2, ratio of sharing the remaining share between A and B is 3:2. So on this basis, let us calculate what are the new shares of A and B as well as C. A's new share is equal to remaining share is 3 by 4 into ratio of sharing the remaining share for him is 3 by 5. So when you multiply 3 3s are 9 divided by 4 5s are 20. Similarly, in case of B, his new share will be remaining share 3 by 4 into his share in the remaining share is 2 by 5. So when you multiply 3 2s are 6 divided by 4 5s are 20. Then C's share, new partner share, it is specifically given that it is 1 by 4. So in order to equate the denominator, we have to multiply 5 both to the numerator as well as to the denominator. So 1 into 5 is 5 divided by 4 5s are 20. So when we simplify, new profit sharing ratio of A, B and C is 9 is to 6 is to 5. We can't simplify it further, it is the same ratio, 9 is to 6 is to 5. Okay, now we have calculated the new profit sharing ratio. Let us prepare the memorandum revaluation account. As I said, memorandum revaluation account is prepared in two sections. So this is the first section. We are not going to put the line here. We are just going to continue. Just to show you how the two sections are divided. As we discussed, the first section is similar to the revaluation account. Let us just quickly see what are the adjustments to be taken into consideration here. The first adjustment is a provision of 5% on debtors is to be created for doubtful debts. Okay, we have to create the provision for doubtful debt, which is a revaluation loss we show on the debit side. The rupees 200 is written off against the bills receivable. We have to reduce the value of bills receivable. Again, it is a revaluation loss we have to write on the debit side. Then stock is to be valued at 18,000. Earlier the value of stock was 20,000. There is reduction in the value of stock, which is to be again debited, which is a revaluation loss. The value of machinery and furniture is to be reduced by 10% and 5% each. Again, there is a revaluation loss, which should be shown on the debit side. Okay. Then buildings are to be appreciated by 20%. This is revaluation profit, which we have to show on the credit side. Then market value of the investment is only 7,500. Earlier it was 8,000. 8,000 minus 7,500, actual loss is 500, but there is already investment provision to the extent of 400. So ultimate amount which is to be taken into consideration is only 100 rupees. We have to adjust that to the investment provision, 100 rupees. Okay. Then a provision of 3% is to be created on creditors for discount. So this is in anticipation that the creditors would give discount at the time of settling their account. We have to create provision for discount on creditors to the extent of 3%, which is a revaluation profit. Then a provision of 600 is to be made against outstanding legal charges. This is a revaluation loss. Then accrued income of rupees 1,000 not recorded in the books. There is an income which is not recorded. So we are bringing to record one more new asset. So it is a revaluation profit. All these adjustments which we have already discussed in detail while solving the question on revaluation. Please go through those. Please go to that video so that you can understand all these adjustments in detail. Okay. So now, taking into consideration all these adjustments, we are going to prepare the revaluation account. All the losses on revaluation are recorded on the debit side here. Similarly, all the profits on revaluation are shown on the credit side. After that, we are going to close the revaluation account. We get 140 rupees. So this represents revaluation profit because we get the balancing figure on the debit side. This profit on revaluation should be transferred to only old partners capital account in the old profit sharing ratio, that is 3:2. So to A's account we are transferring 84 rupees and to B's account we are transferring 56 rupees. Okay. After this we are going to continue with the second section. Don't put line here. I have just differentiated what is first section and second section. We are going to just continue with the second section. So as we discussed in the theory part, whatever the effect you have given in the first section, that is going to be reversed in the second section. How to reverse that? Whatever the items you have written in the debit side of the first section, all those items have to be shown on the credit side because you are going to reverse that. Okay. So all the losses on revaluation will be recorded on the credit side. Similarly, all the profit which you have credited here, that you are going to show on the debit side. To buildings account, to provision for discount on creditors, as well as accrued income. Okay. You are just going to reverse the entry. Losses which were shown in the debit side, that comes to the credit side, and the profits which you have shown on the credit side, that comes to the debit side. Okay. After that we are going to close the revaluation second section of the memorandum revaluation account. What is the effect you got here in the first section? 140 rupees. In the second section it should be the reverse of that. Here it was net profit in the second section it must be net loss because we have reversed the entries in the second section. Now when we are going to transfer the net loss here, net loss of the second section, it should be transferred to all partners capital account in the new profit sharing ratio. We have already calculated the new profit sharing ratio. It is 9:6:5. So you have to write here in front of the net loss by all partners capital account. Below that we have to show to A's account how much is to be transferred, to B's account how much is to be transferred, and to C's account how much is to be transferred. This 140 rupees is distributed among all the three partners in 9:6:5 ratio, which comes to 63 rupees, 42 rupees and 35 rupees. Okay, so this is how memorandum revaluation account has to be prepared. Let's see some more questions on memorandum revaluation account in the upcoming video. That's it for this video. Thank you for watching.